Hello and welcome. In this episode, we're going to take a look at the unearned income of dependent children. This is sometimes referred to as the kiddie tax. At one time, a dependent child could claim an exemption deduction along with their standard deduction on his or her own tax return, even if their parents claimed them as a dependent. What this allowed was that parents could shift investment income, like interest and dividends, to a child, and by transferring these income-producing assets, the child would then pay no tax on the income to the extent that it was sheltered by the child's exemption and standard deduction amounts. If the child did pay any tax, it was usually at a very low rate compared to the parent's marginal tax rate. To reduce the tax savings that resulted from shifting income from parents to children, the net unearned income of certain children is taxed using special rules. Again, this provision is sometimes referred to as the kiddie tax, and it applies to any child who is under 19 or 24 if they're a full-time student and has an unearned income of more than $2,200 in 2021. A couple of things to consider. Again, unearned income includes taxable interest, dividends, capital gains, rents, royalties, taxable portions of scholarships, things like that. The kiddie tax does not apply if the child has earned income that exceeds half of the support they receive. It also doesn't apply if the child is married and files a joint return, or if both parents are dead. Okay, so for our problem, we're going to consider John, who is 17 years old and is claimed as a dependent by his parents. In 2021, he had income consisting of $3,900 in wages from a part-time job and $4,300 in bank interest. We'll assume his parents filed a joint return and have a taxable income of $120,000. So what we're asked to do is determine his standard deduction, taxable income, the net unearned income for purposes of the kiddie tax, and his total income tax. In this video, we're going to actually do this 3 different ways. We're going to use the Excel sheet I have here. I'm also going to walk through filling out the actual forms downloaded from the IRS's website, and then I'll follow up by showing how to enter the data into Intuit's ProConnect so that you can generate the forms in that fashion. Okay, the first thing we need to do is, and this outline that I have here actually came from my tax law book. I'll put a citation in the description for that. But the first thing we need to do is to determine John's net unearned income. To do that, we need to figure out, okay, what is his gross income, this unearned income? And we're told that in the problem. We're told that he had interest of $4,300. So we can reference that cell. And I've already created some formulas to do some of the math, just to save some time. Now, the $1,100 that we're going to subtract here is part of a standard deduction that children get for purposes of the kiddie tax. The less, the greater of $1,100 or investment expenses. We're not told that there are any investment expenses, so we're not going to worry about that. So we'll just use the $1,100. And this is partly where you see the $2,200 that I mentioned earlier about if the child's income is less than $2,200, if their unearned income is less than $2,200, they don't have to worry about the kiddie tax because this number would be 0 and we'd stop. All right, so we need to determine, secondly, how much are we going to allocate based on the parent's income? Again, This is to help avoid parents sheltering assets and avoiding tax liability. So for the parents' taxable income, we're told that it was $120,000. All right. Plus John's net unearned income. Again, we just calculated that. So we know that the parents have a revised taxable income of $122,100. Now, the tax on the parents' revised income is $18,356. Now, we calculated that using the tax table right here, given that his parents are married filing jointly. We can see from our equation that we're just referencing the revised income minus the $81.50 here times their marginal tax rate, the 22%, plus this amount that basically covers all the income tax for the previous marginal rates. Now, we also calculate the tax as if the parents were not imputed part of this unearned income. And again, we're doing the exact same thing. We're just referencing a different cell. Instead of the 122,100, we reference the 120,000 cell. And we see that there's an allocable portion for the parental tax of $462. This shows up down here as part of calculating John's total tax. Now, so we need to determine what part of the tax is based on John's work. So for his adjusted gross income, we need to add together his earned and unearned income. So we will just add these two. And we see that he had $8,200. Now, again, the standard deduction, as we'll see in just a second when we run through this, the standard deduction is $1,100 or the greater of earned income plus $350. So we know that his earned income was his wages of $3,900. So we know that that's greater than $1,100. So we can just go ahead and say that his standard deduction is his wages plus $350. The personal exemption is gone away. That was part of the tax things that happened. I believe it was in 2017 when President Trump signed that. So there is no there's no personal exemption anymore. So his taxable income ends up being $3,950. Now, we also, from there, we're going to get to subtract out the net unearned income. This is the money that we basically taxed at the parent's rate, so he won't get taxed on it twice. So to do that, we'll just reference that cell again. And again, this money has already been taxed at the parent's rate up here. That's why we're subtracting it out here so he doesn't get double taxed. So that we see that the non-parental taxable income is $1,850. To determine the tax on that, since it's less than $100,000, we actually need to use tax tables instead of formulas. So for $1,850, we see that the tax is $186. Right. From there, we can now find that his total tax is going to be the sum of the parental tax plus the tax on his income that we just calculated, his non-parental source income. We can see that it's $648. I already set these to the answers to reference, so we can see that his standard deduction was $4,250. His taxable income was $3,950. The unearned portion for purposes of the kiddie tax is going to be $2,100, and the total income tax that he owes is $648. To continue with this example, we're actually going to just step through the IRS forms and calculate the taxes. To go through, again, we just work our way down the forms. It's the way I work problems. Other people may jump straight to the 8615, but I'm not going to do that. So we see that his filing status is single. John Q. Public, Social Security number, his address. I always pick Florida because they don't have state income tax. I don't have to worry about that. He does not want to make a donation. Problem doesn't say anything about cryptocurrencies. Someone can claim him as a dependent. He was not born before 1957. He's not blind. Doesn't have a spouse. Doesn't have dependents. A lot of these boxes will be blank. Alright, so as we're going through here, we need to figure out on box 1, what are his wages and tips? If you recall, the problem told us that he made his wages and tips from his jobs were $3,900. $3,900. Right? Did he have any tax exempt interest? We weren't told anything about like municipal bonds or anything like that, so we'll assume no. He does have interest from a bank. That's almost always taxable. I'm aware of no reason where it would not be. So he had taxable interest of $4,300. He has no dividends. He has no IRA distributions, no pensions, no Social Security, no capital gains. No other income from Schedule 1. So let's add all of these numbers up to get his total income. And we can see that he made $8,200. If you recall from our Excel worksheet, that's exactly what we entered as his adjusted gross income. So we got the same result, which we should. Adjustments to his income, again, we don't have any kind of Schedule 1, so we know that his adjusted gross income is going to be the $8,200. His standard deduction or itemized deductions from Schedule A. We know that he's not going to get one of these standard deductions because he's a dependent for his parents. So what we'll do is we will go to the IRS's 1040 forms, and there is actually a form, a schedule to tell us how to calculate his standard deduction. And you just scroll down till you get to the form. Your line by line instructions. Again, this is how I work these type of problems. It just depends on the person. Usually, like say, if you want to know something, you can find it in the instructions. All right, and here's the deduction. I've already actually completed this ahead of time. I probably should have scrolled to that to save some time. Sorry about that. So, did he have earned income more than $750? If you recall, when we were filling out as part of the exclusions before, there was an $1,100 item that we used. Well, if you take $350 and $700, you get $1,100, so that's where that comes from. We talked about the standard deduction being $1,100 or the greater of your earned income plus $350. So as long as your earned income, if it's less than $350, then you're right here and you enter the $1,100. But here we know that his earned income was $3,900, so we add that together, get the $4,250. All right, for his filing status, we enter the $12,550. All right, now standard deduction. Enter the smaller of lines, 2 or 3. If born after this and not blind, all right, so he doesn't get any extra deductions for being over 65 or blind. So we add the smaller, which is the $4,250, and that is the amount. Normally, since it says stop there, and it even tells us that we can go ahead and enter that on line 12A. So go back to his 1040, and then for his standard deduction, we enter the $4,250. He had no charitable contributions that it said in the problem, so we add these together. Again, he has a $250 deduction. No qualified business expenses or anything like that, so we add these together. 1,250. Do the math to calculate his taxable income. Subtract line 14 from line 11, and that is $3,950. Now we need to actually calculate his taxes. So the form that we're going to use is not one of the one that's already there, so we will pick a form, and it is 8615. 8615, and go to the form. Again, we have the information for him, for his father. His parents are married, filing together. So now, let's go through the form and enter in all of his information. So what was his unearned income? We know it was $4,300 from banking interest. Right? Again, just keep reading the instructions. If he did not itemize, which he did not, then we'll enter the 2,000. That's in that initial Excel spreadsheet where it was talking about $1,100 or his investment expenses. Since he's not itemizing any investment expenses, it's just the $1,100 plus the exemption amount of $1,100. That's where the $2,200 is coming from. Alright, and then subtract line 2 from 1, which is not going to be less than 0, it's $2,100. Right, the taxable income, we just calculated that from the 1090, it's $3,950. Enter the smaller of lines 3 or 4. Right, so this is the portion where we're calculating the taxes based on like the parent's income. So the parent's taxable income, we were told, is $120,000. Enter the total of all forms 8615s on line 5. What this is doing here is if you have multiple children that have unearned income, that the kiddie tax can apply to all of them. Now, we weren't told anything about brothers or sisters or anything like that, so we're not going to do that. All right, so now we enter the tax amount on line 8, parents filing status, go through all the forms. Enter the total on 5. There's nothing to enter there. Line 8, add line 6, 5, 6, and 7. So this tells us that the parents' adjusted income for tax purposes, or for calculating the tax, is $122. Again, this is what we saw in our worksheet. Right, the tax on this amount, again, this is the number that we calculated using the tax tables based on this $122,000. We know that was $18,359. Now we're going to actually calculate what the parents' tax were based on their regular income without any adjustments. And again, we did that before and we saw that it was $17,897. Subtract line 10 from line 9. And again, this is the difference that gets imputed to the child's income. This is the $962 that ends up going to the children's, potentially to the child's income. There are some additional steps here. Again, if you had a brother and sister that had also had unearned income, where you can apportion that money gets apportioned to the children based on their proportion of unearned income to the whole. But now, since there's just him, he gets to pay the whole thing. Now, calculate the taxes on there from him. Subtract line 5 from line 4. Done that already. It's going to be $1,800 and $1,850. Again, this is what we calculated before as the non-parental tax. Basically, what this calculation is doing is, again, taking his taxable income and then subtracting out what is being apportioned to the parents at their rate. All right, so we need to figure out the tax on this. And again, we used the tax tables earlier. We already know this because we looked it up. It's $186. Add lines 13 and 15. This would be his total tax, $647. Enter the amount on line 4 based on their filing status. This is $395. The tax on line 4 based on their filing status. Again, what this is saying is we're going to take this number and look on those tax tables to get this $395. Basically, he's in a 10% tax bracket, so he's paying 10% of that number. Now we need to add up which one of these is larger. So his taxes without any parental, I don't want to say penalty because it's not a penalty, it's just an alternate way of calculating it, but his taxes without the kiddie tax would have been $395. But because of he made more than the $2,200, and to keep his parents from being able to shield assets, we had to calculate an alternative tax, and then we entered the larger of the two. Right, so we know that his taxes are $647, which is what we saw before. $647 for his taxes. He has no amounts from line 2 on any of these other forms because he just doesn't have them. Scroll down, skip all of these, start adding a bunch of them together. Again, you're going to get to $647. There's no other self-employment taxes, anything like that. The total tax that he owes is $647. We're not told anything about any kind of withholdings, so we assume that all these numbers are going to be zero, right? He has no W-2 withholdings, no 1099 withholdings. In reality, he probably would have had W-2 withholdings and 1099. We just weren't given that information. So as we scroll down, going through these, there's no combat pays, there's no refund credits. He has 0 total payments. Right? Since there is no total payments and there's a tax due, he's not going to get a refund. He's going to end up owing $647. Now, us as the tax preparer, we would fill out all these forms if that were the case, but it's not. But anyway, so that you see, we walked through the tax forms, we got the same result as if we used our spreadsheet. Now, in our next example, I'll actually input all this information into Intuit's ProConnect and show you how these forms are also generated. Okay, to complete this example, we're going to actually enter the information into the Intuit ProConnect software. All right, as we go through here, we've already created a profile for John. He's a client. You'll see some errors again because this is an educational version of the software. It'll throw up a few errors here and there about e-filing, things like that. I'm not a verified e-filer. Right, so to enter the general information, again, we have the general client information. We can select his state of residence as Florida. If you pick, a state that does have income tax, it'll go through those as well. But for right now, we're just going to use Florida. He is single. His name, to keep from getting an error, we put applied for his social security number. He's a student. I made up his birthday. He is claimed as a dependent on his parents, so for his dependency status, we need to put that he is claimed as a dependent. Again, he's not blind. He doesn't have a spouse, so we don't have to worry about any of that. Alright, as we scroll down there, he doesn't have an IRS PIN, so we're done there. Again, he doesn't have dependents. We're not worried about direct deposit. We're not a community property, state, refunds. We don't have to worry about any of that stuff. Payments, extension, and penalties. We weren't given any information, so we'll just override. We'll just go right on past that. For his wages, we were told that he had wages of $3,900. We don't have, if we actually had a W-2, we'd have more of this information to enter, but we don't. So we just know that his wages were $3,900 from his part-time job. Now, Intuit, the software will try to fill in some of this other stuff for you. Again, we're not worried about that. None of that stuff will actually matter at this point. So we know that he had the $3,900. Again, we don't have a W-2, so we're not going to fill out any of this information. The software is actually really neat as well. If someone does have a W-2 from certain paycheck processors, such as like ADP, it'll actually pull the information and auto-populate it for you. It's pretty neat. Again, we don't have any of that stuff. We're not filing, so we're good there. Now, we also know that he has interest. We were told that he has bank interest, right? It's his interest, and we were told that it was $4,300. There's no other bank interest. We're not worried about there's a lot of information you can enter in here, but we just need to enter this one piece. We weren't told anything about dividends, IRAs, gamblings, tax refunds, etc. We don't have to worry about that. No deductions. We weren't given that information. Nothing about credits we need to worry. So let's look at his taxes. Right, so he's children under 18. We will need to figure this out. So here's the information for his parents, or at least his dad. So his dad, if we don't know the actual information, you can say that it's estimated, and that will print out on the 1040. So I don't know why it does that. I don't know if it's something the IRS flags or what, but you can use information estimated. So we need to know the filing status of his parents. His parents we were told they're married, filing jointly. They're not deceased. We were told that their taxable income was $120,000. Alright, we're not worried about any kind of income inclusions, and the taxes that they would normally pay without any of this other stuff, again, we calculated that to be the $17,897. That was part of what we calculated as well. Again, we could estimate that if we needed to, or if John's parents are actually, turning over his information to their accountant, he'll have it already from completing their form. There's no capital gains, nothing Schedule J's. We just kind of scroll through these to make sure there's no other information that we may want to enter. Nothing there, so we're good. Parental election, we're not going to use that. They could file a parental election. That's another way to tax this, but we're not talking about that. We're not going to worry about any of the other miscellaneous forms. Since we've entered what we have, we'll check the return. We get a lot of errors on this because we're entering made-up data, and the system, doesn't account for that. So these numbers will match. The $3,900 is what we had in wages and tips. His interest income, total income. This matches what we calculated as his adjusted gross income. Which we see that since there are no adjustments, it is his total income and his adjusted gross income are the same. Again, we weren't given any information about itemized deductions. Standard deduction that we calculated, again, his earned income plus $350. So his the larger of the standard or itemized deduction, or itemized or standard, he didn't itemize, so he gets the standard. So the tax before the credit is $684. That's what we calculated before. He has no tax credits because he didn't pay anything, so he owes this. And we can see that his effective tax rate is actually 16.4% instead of 10. Now, to me, the neat part about this, what I use it for with school, is I'm going to then check and see what happens. So you can see I'm a student at Clayton State. So Mr. John Doe Jr., wherever, he has to pay, so the form will actually generate a letter telling him he needs to pay. Here are some vouchers for him to pay. He needs to pay by April the 18th of 2022. The general information, the forms that are needed for this return. He has a 1040 V, that's the voucher so he can pay. Schedule B is where his interest is listed. And these are the forms for other taxes. There's no carryover. We weren't given any information about that. The 8979, some of you may have seen this. Your accountant may give it to you and ask you to sign it so that he can file your returns. And if you're curious, accounting 3250 is the class number for income tax. Right, the 32V, that's the voucher so he can make the payment for his taxes. Now his 1040. If we look at this looks exactly like what we filled out in the prior example. He is a dependent. He did not trade in cryptocurrencies. He had $3,900 worth of income. 8,200 was his total income. His standard deductions 4,250, and there's his tax base. So there's his taxes. Okay, and if we also look at the actual form for where they calculated the tax for the child, again, we'll see that it looks just like what we calculated ourselves using the IRS's form. And you had the unearned income 4,300, 2,200 for the exemptions. We get to do the subtraction, run through the math to find out how much of this gets put toward the parents 2022, their taxes. Again, this is the information we entered into the software, and it calculated this value. We saw that he had the $185 of essentially taxable income. There's a difference of $186 here. This is because I just did 10% as opposed to actually looking at the tax tables and getting the 186. So that's why we see a slight difference from what we calculated before. We can also see the software will prepare the various worksheets that we saw. And this is the worksheet that we completed in the instructions that calculated his standard deduction. These don't apply to us since, again, he can't get any kind of credit since he's claimed by his parents. And that's it. That's how you can calculate the unearned income taxes, or the kiddie tax for taxpayers. Thank you for watching.